Hey, Ronnie. Hey, Ronnie, can you hear me?
Hello. Yeah, I can hear you.
Perfect. We'll start in a few. Let me get Patricia on board.
Okay.
Um, all right. As we wait for Patricia, I think I think she's joined. Patricia, can you hear me?
Hi, yes, I can hear you.
All right, let's get started in a second. Give me a second. All right. Good evening, everyone, and welcome to another edition of Mwango Spaces. We have a couple of spaces lined up this week. This is the second one of three. Yesterday we had a discussion around macro. Today we want to dig deep a little bit into bank earnings in the first half of the year and how they performed and how whether they reflect the earnings do reflect the state of the economy or are they a bit detached from the state of the economy as it is. So yeah, to help break that down, we have two very able speakers, Ronnie and Patricia. So I'll allow them to introduce themselves and where they work before we start digging into the numbers. And my name is Eric Mokaya, the founder of Mwango Capital. So I'll start with Patricia, and then you can tell us who you are, where you work at, and maybe a little bit about yourself.
Thank you, Eric. My name is Patricia. I am an investment analyst at Cyton. Just a little bit about myself. I love anything financial markets. I love diving into the numbers to just to know how is the economy working and why is this doing like the way it is. So banking report is one of the things that I do as an investment analyst. Mostly quarterly. We have our banking reports every quarter. So I'm definitely happy to be here to get into the numbers. Thank you.
Yeah, definitely. We'll share a bit of a link also where people can get that in the course of the spaces. And perhaps, Patricia, because there are quite few women analysts, perhaps you can speak a little bit about your experience in markets, being female, being mostly a male-dominated field. How's been the experience so far?
Wow, that's interesting. but personally, I find it interesting. I find the industry to be quite supportive in terms of. I don't feel like I never feel like I'm a woman in the industry. I feel like it's a very supportive industry. I've had a very supportive team to work with, but all the same, there have been challenges, but I'd not say like there are challenges because I'm a woman. They're just challenges that every other analyst would face. So basically, I find it interesting. There's every day there's a new thing to learn about. Like you'll never be at the top and you'll never say you know everything about the markets. There'll be something new to learn every day. So that's why I find it quite interesting, because every day I know I'll learn something.
Yes. Yeah. Sorry, did I cut you off?
No.
All right. Good to see some lady analysts also in the audience. I see Namsia. I see Kate Muhimbise, and I also see Madam Economist. They've joined us today on Spaces. Ronnie, over to you. Tell us a bit about yourself and what you do. I know you're in between work, so maybe you can tell us a bit more. And I think my analyst here at Mwango Capital tells me that we do need more lady speakers in the future. So yes, Patricia, really nice to have you. Ronnie, over to you. Maybe tell us a bit about yourself and what you do.
Thank you so much, Eric. Good evening once again to our lovely audience. My name is Ronnie Choka. I have been a research analyst in the Kenya, or rather East Africa financial services landscape over the past 2 years. My domain of coverage ranges from macroeconomics, equities, specifically the banking sector, and also I do analysis of the fixed income market. It's a pleasure to be here again.
So you're the one size fits all kind of analyst?
Sorry, I didn't get you.
Are you a one size fits all kind of analyst? Just a joke though.
One side.
Yes.
Largely I'm on the sell side, so we cover listed equities and also public fixed income as well.
All right. Yeah, a couple of people have joined us. I see Saito also has joined. Senti Guy, Bonnie, really nice to have you on board on Spaces today. So we start from the high level, dig into the details, and perhaps have some reflections toward the rear end. So I'll start by Patricia. Maybe you can give us your high level bird's eye view of bank earnings in the first half of the year. Patricia?
Hi, I think I didn't get you correctly.
So we want to take a bird's eye view first of the first half of the year in terms of bank earnings. So maybe you can give us that 30,000 feet view of the ground in terms of bank earnings for the first half of the year.
Okay, thank you. So in my view, I feel like the banking industry remained quite resilient during the you can say the first half of the year. Comparatively with the market, or rather the economy, we can say that the banking industry was because we had a fluctuation of the shilling, we had high interest rates, we had the everything that was going on in the economy, including the inflation, was still settling. So I feel like the banks were still resilient because we recorded a weighted growth, that is the profit after tax, of at least 29% for the listed banks. So in my view, that is quite commendable in terms of growth in the profit after tax for the listed banks. And in terms of we saw the interest income and the non-interest income still record positive growth rates. And this was on the back of the interest rates in the economy, because when the interest rates are high, so the banks will charge high interest rates for the loans that they will lend to the clients. So in that case, the interest income will be high. But on the flip of the coin is also the interest expense, which also recorded very high rates of above 60% weighted. So the two work together because as you charge high interest rates on your loans, you're also being charged high interest rates by the customers that will give you the deposits. So the banks remain resilient in that the net interest income, which is the difference between the two, still remain positive. On the other side of the non-interest income, which is the income that the banks get from non-interest activities like FX income, it faced a little bit, or rather not maybe very little, of a headwind because of mainly the fluctuation of the shilling. Because when the shilling is fluctuating, and in this case the shilling was gaining, the margins, the FX margins will reduce. Why? Because if, for example, the bank gets the FX, the foreign currency, they need to translate to the Kenyan shilling, and the shilling has gained, it means that the bank will get fewer shillings for the same, say, dollars, and in that case the margin will reduce. So we saw a bit of reduction in the FX margins mainly, and that led to a very slow increase in the non-interest income. However, I feel like banks have been able to maintain or rather to tame their operating expenses despite of everything, and that's why we are able to see the positive growth in the PAT. And just to mention on the loan loss provisions, we've mentioned that the environment was not very conducive for the banking industry. So where does the loan loss provision come in as an expense? When the loan book is not quite good, in this case, the NPLs, that is the non-performing loans for all banks, they have been skyrocketing because of the high interest rates. Because now when the interest rates are high, and as a client, I have a loan, there's a very high chance that I may face limitations in my payments. So in that case, the loan loss provision, which caters for the bad debt, will go high, and the banks record that as an expense. So a lot of banks saw that increasing, especially in the first quarter. We've seen banks reduce a bit in the second quarter, which we see as a positive. We see the banks are a bit positive on the economy. Maybe that's why they are reducing the general provisions for the same. That is for the bad debt. So in my view, I think banks have remained resilient even with the market and with the economy. That would be my introduction on the topic. Thank you.
All right. Ronnie, how can banks be performing this well in an economy that is doing that badly? I think that's one of the key things that the Common Money is trying to reconcile.
Okay, thank you, Eric, for your question. I think the banking sector's performance so far this year can be characterized as having been, buoyed or supported by a number of industry forces. Chiefly, we know beginning mid-2023, a lot of Taiwan banks got approvals to roll out risk-based credit pricing, which allows banks to price for differentiated customer risk. This increased the pricing power of these Taiwan lenders, as you can imagine. And they've been essentially able to cost shift a huge portion of their cost base back to clients, in as far as when you talk of the impact of the higher for longer interest rate environment you're in, that has piled pressure on the cost of funds that these banks typically experience. And the response time has been more and more instantaneous. Yeah. However, the silver lining has been that banks have been able to extend or to shift these costs to consumers via their lending margins or their interest rate margins. They price on top of their reference rates. And on top of that, we know the yields on investment securities or government securities have been on the rise across the region. That has increased the reinvestment returns that these banks are realizing. Another industry force that I think has help tailwind banking sector earnings has to be the growing financial literacy and the broader financial inclusion that the East Africa financial services landscape is experiencing. We are seeing deepening levels of mobile financial services, supporting increased usage, and this usage in turn has increased the non-interest incomes that these banks, in the form of fees and commissions, and the standing charges per transaction and so on. So it's a cocktail of forces that is overall helping shift or reduce the costs, while at the same time growing the operating incomes. And finally, I think the fact that banks now have a large portion of their customer base on digital channels, this has allowed them to scale back on the brick and mortar expenses that they typically incur on a year-on-year. And that cost rationalization is now reflecting in the profit levels we are witnessing as of now.
All right. Patricia, then let's double click a bit on the issue of non-performing loans. There are a couple of banks like KCB, which are struggling a bit with their NPL portfolios. I think there's the industry level of NPL is, I think, around 16.3%, which is up from where it was early in the year and last year too. Some banks are operating above that in terms of the NPL ratio, and then some are like Stanbic, managing, I think, a single digit or almost close to single digit NPL ratios. So what's the trend that you've observed across banks in terms of NPLs and how they're handling that, and how that maybe reflects a bit of what's going on in the economy?
Thank you. So for the NPLs, I think for me it's a direct translation of what's going on in the economy, because when you currently we have banks lending rates at even 27%, 25%. So if I'm getting a loan of 25% at a rate of 25%, which is so high, I mean the probability of a default is more likely than when I'm getting a loan at maybe a rate of 15%. So basically that's what's going on. And given that the economy is not quite rewarding to productivity, like if you start a business today, let's say you're operating a business, you've taken a loan, you want to start a business. I feel like the advantage is on the bank more, because they're giving you the money at a higher rate, and our economy is bank dominated in terms of where else can you get the money. So as an individual who is starting maybe just a startup, the probability of that business doing very well and you being able to pay, or rather to repay a facility of 25% is not quite high, to be honest. You have very high tax rates. We have very hard operating environment in general. So I feel like even banks themselves, they know, they've done their credit risk analysis, and they know that the repayment rate is not as high. And even as you check the results for this half, like for half 1 2024, you see that banks have cut on lending, that is the loans to customers. A lot of banks, I think 5 banks of the listed banks, recorded a negative growth on the loans. So banks have become very, you can say, they're also fearing, because now, the NPLs will impact your capital adequacy ratios. So for me, the NPLs is a direct translation of the high interest rates in the country. And up to June, which is what we are discussing, we didn't have any rate cut, the CBR, because the CBR will affect the lending, the deposit rates for the banks. So up to June, we didn't have any rate cut. We were still at 13%. So that has led to skyrocketing NPLs. In my view, I expect the NPLs to, I don't know if the 50 bips change will have a very big magnitude in terms of NPLs. But as we move towards, CBK talked of, a framework to bring in the CBR, a bit down. So as we go that route, we expect the NPLs will ease a bit. So we've seen banks now come up with better, or rather, they've tightened the standards for loans. We can say that. So now they'll want to have, when you're taking a loan, if you've taken a loan, you know that the bank will want to know, how are you going to pay this loan? Is it from your salary? Is it from your business? So now banks want to have another, like, you have to have another option for you to get this loan. If you're getting it from your salary, so they are trying to have an alternative of source of income, whether if COVID happens, you don't have your job, how are you still going to pay this loan? And we also have the alternative sources of repayment are also available from the banks, and we also have seen banks seeking alternative sources of capital. So all these are working to complement the high NPLs, just to help the banks rather to how to deal with this, because it's already there. Like we've seen KCB at 18%. And when you check even the unlisted banks, we have banks even at above 40%. So above 40% is like your loan book, almost half of your loan book, you're not going to get it back. Or rather, it's at the, there's that risk of not getting it back. So you have to come up with a way on how to get that money back. I don't know, but the banks will have to find ways to get the money back, because it will affect their capital adequacy ratios. And, we have that thing by the regulator that now the capital requirement for commercial banks will be 10B from the current 1B. So that will lead to a lot of changes in the industry. That is the banking industry. We are just bound to see a lot of mergers, acquisitions for the banks who will not have met that 10B by the time I think it's 3 years, by the time the 3 years ends. So that's my view on the NPLs. For me, it's a reflection of what's happening in the economy, literally. Thank you.
Yeah, thank you, Patricia. It seems like we lost. Seems like we may have lost.
I'm back.
Oh, you're back. Okay, sorry, Ronnie. It seems like I've lost you there. A quick one, Ronnie, perhaps because of the kind of rising NPLs and also banks reducing lending to customers, I think in H1, I think for a long time, banks in Kenya have been accused of lazy banking. I mean, where they park a lot of the cash in treasuries and then earn a nice return of 13 to, I think, 18% annually. Do you observe that trend continuing in the first half of the year, or have they changed a little bit, maybe to lend a bit more to customers? Ronnie, are you there?
Yes, I'm there, Eric. Thank you. I think the question of lazy banking and banks, allocating higher proportions of their total assets to basically risk-free assets, I think we've seen that pull back a little over the first half of this year, largely because one of the concern around issue exposure risk associated with, of course, the sovereign credit ratings. So we've seen a large number of Tier 1 lenders scale back on their total allocations to investment securities, we used to see total allocations as high as 30% of total assets being dedicated to investment securities. However, that has gone all the way down to an average of around 24%. Another aspect that is promoting this or is supporting a redeployment of total allocations is the risk-based pricing model that is currently in place, which allows banks to add a margin to the base or the benchmark risk-free, quote-unquote, rates that are currently prevailing in the market. And what's interesting is that banks are recording even higher incomes or interest incomes from investment securities from lower government security portfolios. I think we've seen that even with KCB, where they are recording a growth in interest incomes from government securities, while at the same time having trimmed down their absolute holdings of investment securities. And this is absolutely logical because revenue is a function of both price and quantity. So that tells you automatically that yields on government securities have been dialing up really quickly. Last year, we saw yields pace up a whole 600 basis points on the short end. This year, again, we've seen some disturbance, a little bit of easing of yields. But all in all, the general trend has been up on a year-to-date basis. So in terms of now what that boils to, or in terms of lending to the real sector, is that the increased reallocations to customer assets or lending to the private sector has only been hindered by an uppricing in interest rates. So in as much as, yes, banks have more cash to lend, the rising interest rates on these credit facilities and there's uncertainty around, the risk margins or the risk scoring methodologies that these different banks, because they are all proprietary and they are all at the, discretion of each particular lender. So that uncertainty has kind of muddied the demand for credit in the real sector, which I expect should now the only factor that should help ease this up is competition. But the switching costs across competitors is also quite elevated. You mean having to switch up from one bank to the other, nurture that relationship for months or years before you are entitled to, the credit levels you deserve or you really need as a business. So maybe competition will still be the defining factor going forward.
All right, we are almost halfway through the conversation, so it's a good time to invite, if you have any questions for the speakers, do DM us, or just below the pinned tweet you can also write a question. You can also just request to speak also, especially if you have a face that we can see. I think it's a good time also to have a look maybe at the asset quality of some of the banks that they are having. I think banks have been performing rather well. I think in the first half in terms of I think in terms of like the share price and all in the first half of the year. And one that particular stands out is KCB also in terms of the performance this year, despite the sticky issues that in terms of NPLs and asset quality around that. One of the things that I also noticed also from the earnings is also the CFOs, especially the CFO Stanbic, saying that NPLs can be pretty sticky. If you have them, you may have like 5 to 10 years to deal with them in terms of securing the collateral and all those kind of things. Any observations in terms of the banks, in terms of differences in asset quality, around perhaps bank specific in terms of NPLs also, if we circle back to that, perhaps we can start with, I think Patricia we lost her a bit. So Ronnie, you can perhaps comment on that in terms of perception, especially around KCB and the NPLs and how they're handling it and how the other banks are also handling the same.
Okay, Eric. I think by and large, what we've seen across the industry, and maybe if I can narrow down to the Taiwan group, is that NPLs have been rising across the board, only with the exception of lenders like Standard Chartered and also Stanbic Holdings. But on average, industry-wise, we've seen a rise in the NPL ratio to, I think, 16.3% as of June this year. Largely driven by deterioration in the trade, manufacturing, and construction sectors. We've also seen this being skewed to the SME and retail portfolios more so than the large peer corporate and institutional lenders who have managed to hold up despite the challenging macroeconomic backdrop. With KCB, yes, it's true as you point out. They're still grappling with a rise in their absolute and even the proportional NPL ratio. Particularly in the sectors that I've alluded to earlier, and this, however, is reinforced by the fact that they are providing more. On average, the cost of risk has been rising to account for about 2.3% of 230 basis points of the credit portfolio. So in terms of the IFRS 9 coverage ratios, I think the Taiwan lenders are well insulated against adverse credit events. The staging is also looking pretty manageable, if I may put it that way. What now remains to be seen is how fast these lenders can intensify their collection efforts before a widespread deterioration or a widespread certainty that these non-performing loans ought to be, written off eventually.
All right, Patricia is back. Patricia, any observation bank specific in terms of NPLs and asset quality? Patricia, are you back?
Hello, apologies for that.
Yes. Yeah, proceed.
In terms of the asset quality for the banks.
Yes, and then
I believe that's your question.
any specifics, you may have noticed across the banks.
I'm not really. It's only that for KCB, I feel like it's been sticky for quite a bit, and it's been, very conspicuous. So I feel like, but anyway, we have they are letting off National Bank, and everyone feels like it's going to have quite an impact on the quality of their loan book. But generally, I feel like a lot of banks have registered just an increase in NPLs.
All right. Any other observations? I think one of the key ones that perhaps before I come to any other observations, one of the key ones is also the resumption in dividend payments at KCB. A couple of banks also are nice enough to investors to give them dividends. Any observation in terms of trends on dividend payment and capital ratios across the banks? Perhaps you can start with you, Ronnie.
Thank you, Eric. I think by the very virtue that banks have been increasingly efficient in their operations, as signaled by the improvement in their cost-to-income ratios, of course, with a few exceptions here and there, that has really increased the scope for banks to increase their interim payouts. Top of the chart, we know KCB issued the highest interim dividend of 1 shilling and 50 cents. After I think over 6 consecutive quarters of a pause to restore their capital buffers. We also had Standard Chartered increasing their interim offering from 6 shillings to 8 shillings a share, even coming a quarter in advance compared to prior years. Broadly, we expect the full year dividend yields to be much higher compared to 2023 full year dividend yields. This coming, of course, on the back of widening jaws in terms of the comparison between growth in operating incomes versus growth in costs. Costs have largely flatlined. That is even before looking at loan loss provisions, while operating incomes have been climbing at strong double digits for the majority of Taiwan lenders. And this is also complemented by the fact that the market share that these large peer group lenders command is increasingly larger by the day. As of December 2023, I call the CBK banking survey revealed that now the Taiwan lenders command a 76.6% market share, up from 75% a year prior. So not only are they increasingly operationally efficient with a higher scale, but they are even commanding a higher market share overall. So broadly, the strategic factors I've alluded to: increased usage, increased pricing power that these banks have, largely contained cost structures. They should be able to raise their dividend payouts to even higher levels by the end of the year. Maybe I could remind me the second question you asked around dividends, and the second related to?
I mean, just expectations around dividend, and then also I'll come back to that question perhaps. Let's deal with dividend question first. Patricia, on the same question of dividends, any observations? Patricia, is there?
Okay, can you hear me?
Yes.
Okay, I'm saying my view would tally with what Ronnie just said. I expect to see higher, payout ratios by the year ends, because when you look at the annualized yields for the half one, they were given good numbers compared to what we had last year. So in my view, I expect to see higher profits compared to last year. Compare that we have a better operating environment with the shilling. We have the inflation rates. We are expecting even lower interest rates before the year ends. And given that the interest rates seem to affect the expenses more, I expect to see a reduction in the expense, which will trickle down to the profits. So that will lead to higher payout ratios in my view. So I expect to see higher dividends by the year ends compared to last year. Thank you.
All right. Yeah, we are noting down a few of the questions that are coming in. I see Tim in the audience. So Tim, if you can join me a bit on stage a little bit, it would be nice to hear what your opinion is on a couple of things. One other thing, perhaps, and maybe I start with you, Ronnie. A key question is about also how subsidiaries are performing across board. I think one of the greatest contributor to subsidiary to group growth has been subsidiaries for most of these banks, and especially critically for Equity Bank, which has tapped into the DRC market. Any observations across board in terms of the performances of some of these subsidiaries?
Yes, Eric, I think we cannot talk about the story of Tier 1 growth without the broader regional picture. We know that now some banks now have increasingly higher contributions from their regional subsidiaries. Case in point, even the example you allude to of Equity Group, which now collectively their subsidiaries account for 55% of pre-tax earnings, and Kenya only contributing 45%, despite having the majority of their assets here in their home market. And that has been a function of one, aggressive marketing and customer acquisition activities in the regional markets. Banks are really scaling up to the last mile, competing or replicating basically the Kenyan growth story in offshore markets. Most uniquely, even we find in markets as geographically small as Rwanda, having collectively over 200 branches of Kenyan franchises in the space. And so that shows you how much of earnings that are yet to be captured per se, or rather the value that's yet to be unlocked across the region. Broadly, even if you look at the mix across the performance mix across the region, it's broadly balanced. On average, that they're basically around 10 to 20% within the deviations of contributions to profitability. DRC is a very vibrant market, as it were, contributing over 35% to Kenyan or the group franchises that Tier 1 peers are currently holding on to. And what we look at as a runway from where I sit is that the competition will now be defined by how fast, of course, there's a function of the financial inclusion rates. Of course, Kenya is way ahead compared to the regional peers in terms of even the levels of mobile penetration. However, I think as time goes on and as necessary investments are scaled up in these affected markets, we expect increasingly higher contributions from subsidiaries all in all. I think on an industry level, they contribute around 35 to 40% of pre-tax earnings to the group franchise. Of course, there are nuances to this. These are very summarized version. However, there are more nuanced factors to consider in each market.
All right, Ronnie. I think maybe a phone call came in. That's why we were not able to perhaps hear you towards the end. Patricia, any thoughts on subsidiaries and subsidiaries' performance among the banks that you looked at?
Thank you. Just to add, I appreciate the fact that banks have been very keen on diversification, which is a rule for any investment. So they will always gain that advantage from the diversification from different markets. So if Kenya is not doing very well, then we can have, DRC do well for us as a group. So we've seen banks have the banking subsidiaries. We've seen banks like NCBA go the insurance way. They acquired the AIG insurance. So that way they're able to maintain or rather increase and maintain their incomes, both the non-interest income, and also the income, the interest income. So in my view, it's a very good way for banks, and we also expect more expansion for the bigger banks through mergers, through acquisitions with capital calls for the smaller banks. So we expect to see more of it for the bigger banks, acquiring or merging with the smaller banks, which will increase their diversification effect in the industry. That's all.
All right, thank you also. Yeah. So perhaps one more thing to have a look at is I think the Fed is likely going to lower rates globally. I think which kind of impacts the global markets next week when they meet. I think our own here, CBK, is likely also to lower rates when we enter some more as they started in from the last time they met. Any perception, I think, on how that might impact markets, especially locally, as we head into the second half of the year, and perhaps it's also that point where you can also give us a bit of your outlook for the second half of the year. Ronnie, you can start with you.
Thank you, Eric. I think yes, there are increasing expectations of interest rates starting to come down, especially in the US, which is a key market that all other markets are anchored to. And starting with the scenario of if interest rates come down this month, we do anticipate that we will see a widespread. It will totally recast the narrative altogether in as far as the direction of cost of funds is concerned. Broadly, we start to see a general easing in yields, both treasury yields and even the benchmark rates across other central banks. Even here in Kenya, we do anticipate that once the US Fed cuts the benchmark rate, we should have increasing expectations of our CBK going in line just to maintain the same interest rate differential. To avoid the excessive pressure on the shilling, while at the same time easing the cost of debts overall. I think it will be a very tactical opportunity for the CBK to take advantage of. In as far as lending rates, we did get confirmation from the CBK that indeed lending rates will be responsive to changes in the benchmark. So even lending rates are expected to come down even if at least not by tandem, we expect that downtrend generally, and that should unlock more lending to the private sector, easing the crowding out effect that has been taking place over the last 3 years. And if now the other scenario, that is if interest rates remain higher for even longer, we should expect sustained pressure on yields. We'll expect treasury yields to remain at elevated levels for even longer. Pressure on cost of funds is likely to persist. CASA ratios are likely to increase owing to the fact that customers are now demanding higher returns on their deposits. So that will push against the net interest margins for Tier 1 lenders overall. Another factor, of course, is that lending to the private sector will largely remain diminished. We noticed the private sector credit growth rate coming in just at 6% when it's been playing at very high double digits over the past decade. So that shows you the pressure on the compressed demand for credit, as it were, in the market.
Yes, definitely. Patricia, any thoughts on the same?
On this, I think it just trickles down to what Ronnie has said. The US will affect, if the US, eases the interest rates, it will affect the whole world. A lot of countries will now be, will be in a more comfortable place to, to ease their rates. And, the easing of rates will trickle down to more lending. In my view, even the NPLs will start easing a bit, as much we say, as they'll stay for the long term. So I foresee increased lending to the private sector, because now banks will not be so, they'll not be eyeing the government securities as the best investment. So now, because normally lending to customers has more income compared to lending to the government. As much as we say it's a risk-free rate for the government, lending to customers is normally it's more profitable. So we foresee a situation where banks will now increase their lending to the private sector. Currently, we have the sector receiving credit growth of about 4%, which is, I don't know, we've had averages of at least 13. So 4 is way too low, as much as
Patricia, did we lose you there?
Okay, can you hear me now?
Yeah, we can hear you now. Okay, you can proceed.
Okay. Yeah, I was just saying that 4% for the credit growth for the private sector is too low. So an ease in interest rates means that we are going to see more credit being advanced to the private sector, which in turn will lead to, more activity in the economy, which is a positive thing. So an ease in interest rates now, in my view, is a positive thing, because even in the US, inflation is in check. And inflation, we can say, even in the country, is in check. So in my view, it's a good time to bring the interest rates a bit low. It's had, a lot of negative, impacts in the economy currently. So it's a time to bring the interest rates a bit low. Thank you.
All right. And towards the end, I think we've been joined by our local analyst here, Tim. Tim, can you hear me?
Yeah, you, Eric.
Yes,
Can you hear me?
Tim is the writer of our weekly newsletter and does a lot of the analysis in the back end. So perhaps, Tim, you can also give us a few thoughts on what you picked up in terms of first half, in terms of earnings trends across banks, and some of the statistics that you may have found very interesting for you. Over to you, Tim.
So, yeah, thanks, Eric. So, in H1 2024, some of the key highlights that were there, in fact, the top, it's just about the regional subsidiaries anchoring earnings, because when you look for the major banks, in the Kenyan operating environment. The numbers were down relative to 2023. So you see the regional subsidiaries coming in to just anchor the earnings. For instance, just for Equity Group, in 2024, Kenya contributed 45% in profit before taxes. When you just look at it in 2023, that was 55%. So you see 10% that it was covered by the subsidiaries. And if you try to look maybe just back, maybe let's go back to 2016, 94.7% of profit before tax was just from Kenya, while the subsidiaries was just about 5%. So you see the subsidiaries have it has just they've just stepped up, and they've taken that place, that void that had been left with the underperformance in Kenya. So just to move forward, we also seen another trend was about the in the income statement. We look at the interest expenses. So as a result of the high interest rates in the economy, so we've seen that the interest expenses have surged, in some cases outpacing the growth in interest income. So just as we see there's the cut in the CBR, so we expect that this is going to unwind if the CBR is going to continue to come down. That means that the aggregate cost of the cost of the deposit is going to come down, because now the interest rates will be coming down across the board. So that is something that is key to watch out going forward in H2 2024. And then when it comes to the asset allocation, as lending, you can see that across the banks, you find that it was generally modest growth in lending. So some ABSA, Equity, and DTB, you find that that you see that in the operating period, the lending contracted, and when you check them according to you juxtapose them to the balance sheet, you find that Stanbic Holdings was the outlier, having at least over 70% in its in lending. So the growth, generally speaking, it was just muted. And across investment securities, now from the trend that was recorded in Q1 2024, you've seen that there are some listed banks that cut their holdings of securities. Most of these banks are Absa Bank Kenya. So you can say the banks that are mostly foreign owned, which are the three of them: Absa, Stanbic, and Stanchart. So you find that they continued the trend that was observed in Q1 2024. Some of them, it's only Stanbic that increased its holdings of government securities, but you find that Absa, it was down, and Stanchart was just up marginally. So that is also a trend that you observed in the operating period. And then when you go also to the non-interest income, we saw FX trading income, it took a bit of a hit. So as a result of the developments that happened in the currency market, we found out that during the operating period, the income that was generated and earned through FX trading was not that significant as compared to that recorded in the other operating periods. And then in terms of returns, we saw that the dividends, interim dividends, so we saw Stanchart 8 shillings, and then we saw KCB resume to pay a dividend after they halted in 2023 on account of other factors, the recapitalization of KCB Bank Kenya. So it was an improvement when you compare it to full year 2023 for KCB, and for NCBA, you can see it was also they increased the interim dividend relative to 2023. Same for Stanbic, and Absa Bank Kenya, it left it unchanged. So I'll pause at this point.
Thank you, Tim. Quite the roundup there. Let me check if there are any questions that have come in so far, so that we can before we. All right, there's okay. It's something about DTB. can't get the question very clearly. But perhaps now we'll go towards the closing stages of the spaces. I see Stella is in the audience too. If you want to join us, you can join us on the stage too. So I'll start with Patricia. Maybe you can give us your closing thoughts in terms of analysis for banks and any thoughts that you have for the second half of the year, any things that you're paying close attention to, and perhaps any of those things that you're paying attention to, and then I'll come to Ronnie to ask you a specific question also.
Thank you. So on things that I'm paying attention to, definitely number one is dividends, which is very key to investors. Investors will invest for banks, mostly they'll invest for dividends. And also we have the, appreciation of the price. So that's a key thing that I'm looking at, because I'm looking for more dividends compared to last year, because now the operating environment for the banks, we can say it's better compared to last year. So that's number one of the things that I'm looking at. Number two is the cost of funds. We've seen before, we've had cost of fund on average, mainly for the listed banks, even below around 3.5 there. And now we have it at almost 5 for the listed banks. That is on weighted average for the listed banks. When you look at the banks individually, we have banks with even 6%, and that's what we call the tier 1 banks. That I find that too high, because it means you are paying too much for you to get money from customers. And I feel like the money has been, the customer, the money with the customer is under too much pressure to go whether to go to the bank or to go to the T-bills, to the T-bonds. So I really want to see how the year ends in terms of the cost of funds, and that will trickle down to the interest expense, interest income, and all that. But overall, I expect a better performance compared to 2023. I think those are my two main things: the cost of funds and the dividends payment. Overall, I think today has been a great day being on this space. I really appreciate and thank all my listeners.
Yes, thank you on that, Patricia. Before I give you, Ronnie, also to give your closing thoughts, there's one thing that is hanging about the Kenyan economy, also something to do with the IMF and the 7th review, which has been pretty prolonged. Any thoughts on that? And perhaps you can also give us your closing thoughts in that same vein.
Hello, Eric. Can you hear me?
Yes, I can hear you. Keep going.
Okay, nice. So, as I give my parting shot, I think broadly the banking sector has displayed tremendous resilience over the first half of the year, despite emerging shocks towards the latter end of the first half, as the economy was stabilizing, largely driven by anti-government protests. Subsequently, since then, we've had credit downgrades or sovereign credit rating downgrades coming into the picture. So that should compel a majority of Kenyan banks to scale down further on their holdings of government securities, if at all they want to preserve their cost of borrowing margins, or rather the ease at which they can acquire inexpensive credit from other lenders. And in as much as, yes, inflation is easing and we expect economic activity to tick up, that is likely to take longer than expected, going even by the PMI measurements. Apparently, the political unrest over the past 2 months has stoked a lot of uncertainty as far as price levels, and that is the expectations of future price levels are concerned. And going by the IMF, the issue of the IMF 6 reviews of the extended fund facility and extended credit facility, certainly, of course, it's in the works. We should expect, in as much as it has been prolonged, we anticipate a successful conclusion to the same. Of course, there are a number of concessions we expect the National Treasury to make From the last review, they were discussing about privatization of national assets, including Kenya Airways and Kenya Power. Maybe that can likely come much more to the fore on top of more long-term tax reforms in light of the recently rejected Finance Bill 2024. So I'm sure the reason for the delay, or I'm speculating that the reason for the delay in the 6th and 7th review owes to particularly that the number of complexities that have emerged over the second half of this year.
Yeah, and I think now when you put it like that, there's a lot of stuff hanging about the Kenyan economy going into the second half of the year that still remain unresolved. And today, there was also the hearing about the Finance Act 2023. So quite a lot of loose ends here and there that needs to be tied as we go into the second half of the year. So a quick question, Ronnie, for you. Someone has asked, how low can the CBR rate go?
I think there's no telling how far it can go, but I don't expect abrupt movements in the CBR at any particular convention. Maybe largely to a maximum of 200 basis points on the downside. I expect them to maintain a considerable differential with advanced markets, keeping real yields positive so as to preserve the pace at which portfolio inflows are coming into the space. I don't think the Treasury would want to trade that off, even with the prospect of growth, largely because our forex reserves is largely the precarious level. So we still will likely still remain in the higher real yield territory for much, at least for the next 4 consecutive quarters, or until we get liquidity injections that will replenish our forex reserves account. In terms of a more definitive outlook for the second half of the year, broadly expect the disinflationary trend to persist until the end of the year. Interest rates currently expect them to nudge lower, largely driven, of course, the developments both globally and even domestically. A lower inflation outlook supports an easing, or supports the case for an easing of interest rates. In terms of the exchange rate, we've seen some stability, or largely owing to the stewardship by the Central Bank of Kenya in spearheading reforms to the interbank foreign exchange market. Those have helped remove much of the sentimentalism that was largely driving the depreciation of the shilling last year, in my view. Thank you.
The shilling has been better for many this year. Remember, we were almost going to 160 plus, and then now we're at 129. So pretty good. Team, any observations from you, maybe from that you take away from the first half and something that you're watching as we go into the second half of the year? Perhaps as you write the newsletter, what are some of the things that are jumping out for you that you're watching? And perhaps any perspective that you have on the IMF review also, which has been pretty delayed and prolonged.
Okay, thanks, Eric. So going into the second half of the year, of course, now on the macro part of things, you can see that the CBK cut rates in its sitting on August. So it's a key indicator to watch, because across the hiking cycle, during that period, they said that they were attacking the reason for the hikes was to combat inflation and also to stem the depreciation of the exchange rate, because part of the inflation was being contributed by the depreciation of the exchange rate. So we've seen those two variables, they've been unwinding from H1 to H2. The shillings has appreciated relative to the dollar, and you can see that the inflation has also been around there, 4.3, 4.4. It's within the CBK's target range, below the mid-range. So the unwinding of those variables going into H2 2024, it's supposed to give some relief at a high level, because now you can other variables like extension of credit to the private sector, general lending to the economy. We expect that that's going to recover, and then PMI index, we expect that we're going to get some dividend from as a result of the improving of those macros. Another thing that I'm watching, looking at, is on the fiscal. So you see the Finance Act 2023, there's still some legal deliberation going on in the courts, and then the situation of the Finance Bill 2024. So as a result of those developments, so looking at just the revenue numbers and whether the targets are going to be realized, that's also something I'll be looking at, given into context that revenues in July, they did not grow at a faster pace relative to 2023 and relative to other years as a result of just the events that surrounded the month in terms of the fiscal. So I'll be looking at that. So we'll be seeing also the IMF program. They're supposed to, there's a disbursement, the last review, but it has since delayed. But on that front, there's the World Bank funding. So it will be critical to see how the distribution of the last disbursement under the EFF and the ECF. So we'll be looking at how that goes and what that means for the economy, what it means for the fiscus, and what that means in light of the downgrades that Kenya has been receiving from the credit rating agencies. I'll pause at this point.
Yeah, quite a lot of stuff to be tracking the second half of the year. But yeah, Tim and Ronnie will be here. And I think we lost Patricia a little bit. All right, guys, I think we should end there for today. Thank you, Ronnie. Thank you, team, for jumping in. We'll hope to host you again. And Patricia, who left a little bit earlier. Thank you so much for joining us today on this analysis of half one 2024 results. We will be having another spaces like this at the end of after the Q3 results are released. Q3 ends next month. Actually ends this month, and then earnings should be around by the end of November. So the Q3 earnings, so we should be able to analyze those. And then something else, we'll have a spaces on Thursday focusing on OAR and insurance. So if you have any questions regards that, Raina Namsia will be here to be hosting this and to be discussing this a bit more this week. Something else to be paying attention to is the Supreme Court hearing on the Finance Act 2023, which is happening today and tomorrow. Very important in terms of its implications in the economy and going forward. Yes. So on that note, really, I think my general takeaway is that banks did well in the first half of the year. I mean, we've been really hoping against hope that they don't disappoint in terms of earnings, because it's been quite a tough period in terms of economic wise, but it seems like they're holding up well so far, especially the top tier banks. So if you're looking to invest, I think those are good places to start in terms of investing. Banks are generally a reflection of what's happening in the economy and in the investors' wallets mostly. And of course, it's also nice some of these banks come with most of them actually come with dividends and dividend play. So it's good to keep investing. So our aim is to make sure that you enter the space of investing and make sure that you also tap into some of these earnings, or just listening in. I think on that note, unless Ronnie or Tim has any comments to add, I will close the spaces at that point. Anything from you guys, Tim and Ronnie?
None really. Thank you so much for hosting me, Eric. It's been a pleasure.
All right. Thanks, Tim.
Yeah, thank you for hosting me. It's been good to be part of the discussion.
All right. Take care, guys, and see you again next time. Bye for now. I'll end the spaces now. Go ahead.